Hi there all, hope you can hear me. Sorry, it took a little while there, just getting myself organised bit by bit. So we got Bobby, Helen, Peter, Gino, is your gang. Be a few more coming in slowly, I'm assuming. All right. Am I coming through loud and clear? Ah, legend. Thanks, Helen. Just thought no one was listening to me again. Okay, I'm in a bit of a crazy mood today, I think. Let's get into it. Welcome to Trade Setup. Thanks for joining me. For anyone that's new, just remember you can join us at Twitter, top left-hand corner. Again, Facebook, very similar to Twitter. We're probably more active on Twitter. And the bottom right-hand corner, subscribe to us at YouTube. So at TradeSetup, capital AU. You'll find us. If you're having problems, just give me a yell and I'll send you the link. You can send that or just send a request to support@tradesetup.com.au. And what we'll be doing, I'll be doing a talk on Thursday. I think it's ATAA talk on Thursday at 8 p.m. It's the 26th, a couple of weeks, which we'll be touching on a bit more of what I'm going to just have a bit of a quick chat about today. So anyone that's actually in ATA, I think it's an online, not going anywhere today. G'day, Mark. Not going anywhere this time. It's more of just an online talk which people can join in, sign up to, join in. And hopefully I'll get the recording and be able to upload it to yeah, Bobby, thanks, mate. Bobby knows. Bobby got me organised to do it. So we'll be doing that and uploading it, hopefully, if we can, to the YouTube site. So you should all get that. What am I going to say? So yeah, just bear that in mind. If you link that if you sign up to the Trade Setup or subscribe to YouTube, you'll get that pop up as soon as it goes live. Or I don't know, what do you get? You get to hit the bell button to get notified. Someone that's more astute will know. Yeah, we're talking about ATA. Is anyone? I think it used to be quite big, and we've done a few talks in Adelaide. I think Dav's done. I think I've done 2 or 3 in Adelaide. Got someone there. Dav's done one in Queensland. Um, they're really good, but I think they might lack a bit of direction. I think it's slowly slowing down. I reckon it'd be great if they can get organised and promote themselves more because it's a good little. It's a good way for people to get educated for free, I guess. And they're getting, if they can get traders in, not just spruikers spruiking business, but if they can get some traders in there that have got the experience, that just talking different ways of what they look at, it's a great education, I think. Too much booze. So I think if they can do that, and what I think they need to do is move with the times a bit and do some online stuff. So it's good to see that Bobby put me in touch with, I don't know which group he's with, if it's just Melbourne or whoever they are. If it's the national, might go up online nationally. Do an online talk. I think that's a great idea because what people could do is refer to it later. They can, if they can't make it at a certain time, and it's easier for me. I don't have to get on the plane, travel all the way to the airport, jump on a plane, jump over, do a 2-hour talk. It takes you 2 days to get organised. So I think it's great, and I think that could bring in some new members because it's good quality content. There's a lot of people out there, traders and such. It would be easier to do it online. So I don't know what everyone else's thoughts are. But anyway, here's my rant. There is my rant. So I reckon it's good. So what we'll do today, we touched on this morning of Friday night markets. I think we're mentioning didn't do too much. Nasdaq down. Was it European markets are up? The Dow was up, and the broad S&P was up slightly as well. Not a hell of a lot. I think they were doing their thing, rallying until they had numbers out prior to the open, which sort of cooled that night. They had employment data, so employment data came out not as strong as expected, and that's the biggest thing they're looking at for growth. That stays, I guess stays level, keeps growing. Then they don't have to worry too much. But Adelaide, yeah, Adelaide meetings are more of a social occasion. It's great, I think, but what they actually should do is start recording them and putting them up online. If someone can whack in a camera, record the talk, put it up online, I think it's a great sort of source of of education that people can refer to later on, rather than if they can't make it to the night, they can't see it. Anyway, where was I? So US US is just doing their thing. Numbers are the important thing. They've still got unemployment of 3.7%, held strong. As long as that sort of continues the same down the same track, jobs keep slowly growing, then they're not too worried. I think that's what's been buoying the market against the bullish sentiment, or sorry, the bearish sentiment. They're looking at, they're still putting on jobs, still growing, and I think who was it? Powell came out and said at 2:30 at his talk. He's spruiking really more than anything, trying to support the market, talking up. He was saying that he doesn't expect a recession because he expects modest growth both in Europe and US. So if that continues on, then everything should be good in his eyes anyway. But he's still going to cut rates and potentially cut them twice. So it's kind of funny. Without stimulus, they're pretty much up the creek. And I think, like everyone is expecting, they're running out of bullets. They're talking it up, saying, "Oh, we expect modest growth." But if they don't get it, and if the jobs numbers continue to slow, that's one thing. It's a negative, but they also had a positive. I think it was wages growth was higher than expected. So that sort of offset the drop in employment as wages growth. And they really do need the population or the consumer to keep spending, to keep the growth going. Now, if they stop spending, they're going to have a few issues, I'd say. And that's because there's a fair few headwinds, especially if the trade war continues. Now, again, the trade war they're talking up a meeting, high level talks, but there's no dates. So it's kind of funny actually. That's what's driven the market higher. Some good started off last week not so good on the back foot, and then turn around and bounce. You got Brexit. What is it? A hard exit was negated, potentially negated. Then you've got China was talking meetings with the US. They're talking stimulus. Trade wars potentially better than what they think. They're talking up coming to some sort of agreement, but realistically, they're still adding tariffs, and they're due to add tariffs at the start of October, I think, the US on Chinese goods. Chinese economy is slowing. They had some numbers out on yesterday, I think it was, slowing. So it's not a good scenario. It's not a good backdrop, but stimulus seems to be what's keeping the market ticking higher. We're sort of getting at that level now. I'll bugger that off. Getting at level now where it's going to run, the rally potentially could run out of steam. So we touched on that this morning. Let's just have a quick look. Let me get rid of this. What I'll do is have a look at the daily charts on the major markets. Go away. All right. So this is the S&P 500. You can see it's sort of up in that highs. The all-time highs are just a touch higher at 30.25. We're about 60 points, 50 points from that. You can do that in a session. One good session, it's up there, or a couple of good sessions, it's right into new highs again. And that's not a bad little base. It's just the fact that it's broken this trend here. So it could easily pop out. And what it's done is dragged in a few bulls on the break of these 24.45, for instance. And that was on, what date was that? So that was Thursday night, broke that. Sideways, sort of an inside bar, if you can see what I'm talking about, on Friday, which is kind of a flat session. We can easily drag in some of the bulls and come around and just cave in. We are getting extended up here on the stochastic, so the buying pressure has been quite good. It can't quite get to the highs. I mean, it's not there yet. It could easily pop up to the highs, but there's a few sort of technical signs where this could still roll over. Dow, similar type of scenario. It's been in this liquidity zone, we'd call it, once, twice, three. We'd push through it. It's back there now, so it could easily find some liquidity in selling pressure and build a lower high, and that could be a washout, especially after breaking this uptrend, and have a deeper correction to reset itself. Again, who knows where it's going to go to if that's the case, or this could just keep tracking high and take out the highs, make new all-time highs, which the Yanks are bound to do, I'd say. NASDAQ, I don't really look at this as much as the others, but similar type of scenario. This, you can see the one thing we're going to look at is the strength of the move through. Okay, it didn't move through that much before it had deep correction, and then next time around it's gone through, popped through the highs, the all-time highs, not by much. This time around it could easily get through those highs, but you could be looking to a move somewhere up to, it could be a little bit less. So it could easily pop through the highs, get people on the bullish side, which they probably should be at the moment anyway, because the market is popping up. Get on the bullish side, get through the highs by 10 points or so on the broader market, and then turn around and cave in and get this sort of scenario play out, which potentially, if that holds there, we could have a deep correction, not so deep, or we could just smash down and take out, retest these lows. So yeah, you can see the way it's getting through the highs is not convincing, and it's deep correction, jabbing all the way back up through the highs, deep correction all the way up. It is contracting, so the way it's contracting up the higher lows is quite sharp too. So that it's all these little factors. It just got me on the back foot, I guess, or sorry, to be on the front foot with risk. So that was Nasdaq, DAX. That to me is really sort of more in a downtrend than anything else. And if you look at the DAX, we've got this trend up. This move down has broken the anchor to that trend up at about 11,633. So that to me, generally, if you're going to have that secondary move lower, just say this is your first move, go out of the way. That's your first move lower, pop up, lower high, a secondary move lower could take us anywhere. It could take us all the way back down to say 10,400. These lows from, what was that, December. So just be wary of that. And then we've got UK. They seem to be still choppy. It's hard action to read. You got this little push up, then bang, caved in. And I think they're obviously got the concerns about Brexit, what's happening with Brexit, all that sort of stuff. But realistically, it's that move up through, sort of out of that contraction there, that contraction lower. It's more swinging between lows and highs. I think that's more sideways action on the longer term than anything else. And it is choppy. You get this grind up, and then boom, it gets really knotted on the head a bit. So we'll see how that plays out. As for our market, let's just go. I want to go here. We'll get on the index. One thing I did notice this morning is, I want to draw this up, don't I? I want to draw it up relatively. Does this help? That might help. Oh, that won't help. There you go. It's momentum as well, so it's a good idea to keep an eye on the momentum of each move and what's happening. And it's just something, it's only minor, but I'm going to keep an eye on it to see how it goes. Now, I've just point out, so this is the sell-off last time. This is what I'm more or less, I guess, using as a reference of what potentially could happen. So you got the market sold off, and then you got this, we've spoken about this quite a bit, this sort of gradually grind higher. It kept below the MAs, so the MAs had crossed down with this, this push down. They crossed down, it basically went up, touched the MAs from the bottom side, and then sold off, and you got this heavy sell-off. Now look at you obviously expect that when you get a sell-off, that's sort of that initial reaction lower. All right, so that's probably your first, anyone that's had stops, tighter stops, say, but potentially below that low, let's just draw that, below that low, stopped out. So that's sort of the first wash, and then it runs out of steam for the downside. And what it's doing is building up potentially another bout of steam, you'd say, or fuel when it's grinding back up, held at the MAs. So then you get anyone that's potentially missed this exit and wasn't really, well, maybe not taking note, but didn't believe it, has watching this grind higher. So if you're astute to your technicals, you'd be watching that going, that's not bullish. That's not bullish. And they may have had their on it, then you start getting it knocked on their head a bit. They're bailing. So you've got people who maybe missed this initial move are starting to bail. So it sort of goes back in the queue. If you imagine this as a queue of sellers, it takes the first few and then it starts going back as these other ones come under pressure. Sellers earlier on come under pressure. And that's what's happened. But look at let's go back here. Look at the stochastics. So heavy selling pressure, you're going to get some sort of reaction sooner or later. It's going to run out of steam on the downside. You got that reaction back up. Buying pressure took it all the way back up to sort of overbought, got nowhere near this high. All right, the high was a lot lower, and then it sold off again. So it's gone from overbought to oversold down here. But look at the momentum too. So the momentum, you tend to like buys, the momentum's slowing when it's coming down and it crosses through. So it goes from sort of buy momentum to sell momentum. And a lot of the times we're always looking for this. It goes back to the zero line. And this is something we'll probably talk about a bit later on with what we're looking at. Goes back to the zero line, and then it can extend. So that's okay. The momentum's crossed. It's got a bit out of hand, and it sort of plays into what's happening with the MAs, what's happening with the sort of grindy price action, what's happening with stochastics, the buying pressure, all these sorts of things, and then it starts accelerating again on the downside. So it's sort of a lot of the times you can see they tend to cross over, pull back, and go again. And any bullish move you can see here, it keeps coming back to the zero line and accelerating back up again. And that's more conducive to a trend. But it stays above the buy line for, what am I saying? Above the buy line, above the zero line for buying for a trend up, and the same on a trend down. You can see it's less. It's not as clean on the sell side because it tends to go harder and faster. But you can see what I mean. It's sort of the sellers selling pressure on the below the zero line and buying pressure on the above the zero line. A lot of times when it comes back to the zero after crossing, and you get this sort of setup, could easily get it. Or look, it did. It got smashed down, and you can see that really started picking up momentum. You got your lower highs coming to play, pressing the market down until it turned. I don't know where this probably it come into about here when it crossed back above the MAs. But what I'm saying is that we got maybe a similar scenario. We've got this bit of a sell-off down here. It's been buoyed in here. Stochastics in heavily oversold. We've gone through the zero line. We're just at the cusp now where it could easily play out something similar. And this is just using your buying pressure, your momentum, and all that sort of stuff, negating where that price is, because we all sort of knew that 6,600 level gets through there. Yeah, there's going to be a bit more bullish movement, but we're not worried about that getting through. What we're worried about is continuation. And if we don't get that, because we're running out of steam here, we might just run out of steam, bang, right here, just a line in the sand, turnover. The MAs are still down technically. They've probably come back to even. 20 and 50 are not really crossed up. They're not down. Maybe they're pretty much smack on. And there's no reason why this can't sell off from here. It's just if we see this momentum start to ease with a couple of down days, we've got this similar type of setup of what we saw in the past. I'm not saying it's going to happen, but just be on your guard. We might, and that's a different type of pattern. It's started to get buoyed. We've got that cup. It might spike up, so you can get these moves down. It starts to get buoyed, and then you start to get spike up, and then boom. Similar type of thing as what we saw here, but different style of price action. And we come off the highs here, so we're still waiting to see what's going to play out, whether the bullish move is going to continue and just drive higher, and we're just going to hang around that overbought mark. We'll cross back up into positive territory on the momentum, or whether we just start to roll over from here. So all these sorts of little things you start to piece together of what you could expect, but what do you want to see here? Because we've broken back up above 66, as opposed to this type of action. So this action was more, grindy up like that. So we've got a clear type of setup. If it goes through that support, bang, you either look for a lower high or you can just sell it on that break. So if you sold it on that break, it was somewhere around here with a stop above, you're pretty clean. You're still held in there. Or if you look for the lower high, then you've got an entry slightly lower, but you've got clearly defined risk as well, and you got more of not so much clearly defined risk, but as a clearly defined setup. You're on the right side of the market, whereas that entry here, as opposed to off a lower high, that there is telling you're on the right side for sure. Whereas here, yeah, you could come down, you can bounce straight back up and wash you out. You can get chopped around easier, but you get a better price. So that sort of price action was a lot different to what we're seeing just now. I mean, this may be still taking some time to play out, may get grind in where it's capped on the upside, and you get this higher lows squeezing in, and you get buyers starting to step in constantly sort of around at 65, 66.50, 6,700. Sorry, sellers just constantly coming in, buyers starting to run out of steam, and then you get that sell-off. But again, I'd be more inclined to look for a lower high in that setup if that's going to play out. Does that make sense? So that's just what we've got my eye on at the moment. If we start to break down, now if we break down on this daily chart, remember we've got this move down, just say it's 69 down to 64. It's a 500-point move. Say it's from 67, we could easily be down at 62 or further, just finding out where potentially we could head to. That's a bearish case, or we just keep grinding higher from here. So we've got some longs on, which is fine. We're happy with. they're not. It's a bit of a mixed bag at the moment. We got into one this morning, turned around and went straight back down again. We're still looking okay. It's just that it stopped in and then turned around, and it's against us at the moment. Obviously, gold has taken a bit of a hit. What do we got? DCN, I think. Yeah, down a bit today. So, we've got a mix. So some are offsetting the others, and we're still grinding our way up, which is good. Market's very flat today. All right, so that's what I'm going to touch on. So what we'll go into now is I'm going to discuss something. We'll just take a bit of different talk today rather than just talk about shares, but we'll talk about something we're working on, Davin and myself, and sort of trading styles that we've been using of late, and what we're going to build up education around, and we're going to do some talks around the traps, I guess. But I just want to discuss, and it'd be good to get any opinions on what you think, if it makes sense, or if there's something that doesn't make sense that we can work on, or whatever it may be. But I thought I'd show you guys first. But it's basically a trading style we've always used. Davin's used it probably more often than me with intraday. It's good for intraday, but it's a similar type of approach end of day as well. It's just a stock standard approach. There's some things you're looking at, whatever time frame you're looking at, that can be applied sort of across the board, whether you're looking at a weekly, a daily, a 30-minute, a 5-minute. I used to go down to a 1 minute. I think that's probably stretching it, and that's probably where I had most of my issues, was looking at a 1 minute. But that's for your pure intraday trading. It's a similar type of approach across the board that we're starting to obviously refine, but we'll let you know as we go forward. I thought I'd touch on it today, the key points, and see your thoughts. So now, what I'll start with, just trying to find out, I want to find a good email. All right. So I'll start with just describing, this is probably a good one. No, whoops. So does everyone see that clear enough? Is that, should I be having that? Let me just see. Is that coming through clear? You can probably read those. If not, just email me. What I can do is email these out, put them in a file, and email you out the actual the snapshots. All right. So you've got that chart there. So what we're looking at basically, the style of trading, which a lot of people probably know, is we call it inside out and outside in. So generally what we look at is outside in style of trading. Sorry, inside out. And it's probably more often than not, that's what the style that, you've seen me do things over in the past, is what we're looking at with trading. And by outside in, you mean sort of the market's come into contraction. It's come to sort of that point of agreement, and then it's starting to expand. So we always bang on about coming from contraction, going into expansion, and you want to try to pinpoint the times when it's going into expansion. So this, you could essentially draw this up. Let's just draw this up. And this is a stock we've got at the moment, Zip. And you can start to break it down from inside out style of trading and different reasons of what we're looking for. All right, so you got the market sort of contracting here. It expands in here. Even here, you've got that it's contracted. The MAs are caught up, and you're looking for this inside move, expanding out. All right, and then from there, it's trying to manage your risk as you go up, where you're looking to get out, whether you want to take some off, do you want to ride it, what do you want to do? But that's what we're basically looking at. And it was again here. So you've got, if you go down to the weekly, it's probably quite clear. This weekly chart, let me just make that a bit smaller. The market's expanded. All right, so we've gone, when you get into about here, if you're looking at it here, you're probably running the risk that the market's already expanded. It's already, yeah. So this is probably what I'm going to touch on more, Bobby, with the ATAA. But it's a general overview of the style of trading and what we think works, and you can sort of be mechanical about it. And hopefully, what we're aiming to do is take out the guesswork, but you're looking at these two style of trading that you can apply across the board. Obviously, you need to tweak for different time frames. You might have to tweak your settings, but you're looking for similar style of trading. One's harder than the other, So inside out, where you're having the market say here, come into contractions, coming back to the MAs, and you're looking for that expansion out. So inside, out is what we're talking about. And you're looking to take, and it's probably what you'd be using, will be a lot more common on shares, is looking for that inside out style of trading because things expand more and they can really get a run on. Whereas indexes, currencies, things like that, you're probably looking at an even keel of both inside out and outside in. By outside in, you're meaning when it's getting exhausted. Say you've got this big expansion candle, so that's brought in a lot of buyers. Then you've got an inside candle. This is on a weekly, don't forget. Another go at the highs, and then you've got this fourth candle on the 20th. You can see it's got through the highs and it rejected it. So that's where you're probably looking at, your momentum settings, where you are, and looking for an entry on the short side, or you're just looking to get off, take off, close it out if you're long or whatever. But if you're just looking at purely at, okay, I'm here, would I want to buy something for a run up? You're probably going to be on the wrong side of the market for at least a while, or completely on the wrong side of the market and stopped out. So if this goes up here and comes straight back down again for whatever reason and resets down at 120, then you got stopped out or you're sitting on a bad loss. So that's why you'd be trying to gauge of what style would it fall into, outside in or inside out. So this one here is outside in. All right. So where you're looking for, and if you're just looking to enter, like I was saying, you're not long, you're not short, you're just neutral. That's the one that you'd probably be playing out, and you're looking for some sort of pullback to the MAs, and it's more reversion to the mean as well. People have heard that before. So generally, the market will swing. It swings from higher lows, higher highs, and then it might contract, like you said. It goes through those periods of swing. So it comes up. Let's just draw it up. Even if it's a rally, you've got that extension higher. So you're looking for your pullback, and then this is more of your inside out, outside in. Outside in here, pullback, and then it pops up. Does that make sense what we're looking for? So that's your standard trend. Everyone knows that. You got trends always go in swings, swing highs, swing lows, swing highs, swing low, and so on. But there's opportunity on the downside, depending on, especially if you're on shares, if you're looking at the weekly chart, there could be a really good opportunity on the downside with minimal risk. And what we find too is intraday, the outside in style, once you've got it, you know sort of what you're looking for, and hopefully that's what we'll be talking about, or that's what we'll be teaching in, once we start getting together a course of what you want to be looking at, what you want to try and nail down to get you in on the short side, because it is, people can look at it as more risky, but once you know what you're doing, I guess it's a high probability. It's not a high probability. You might be looking at say 65% 65 to 70% strike rate. It's quite a higher strike rate, but the wins are probably not quite as big. But trying to pick it from inside out, maybe a lower strike rate, but you probably find that the returns are bigger, especially when you're looking at SPY trading or your DAX trading or things like that. Does that make sense there, guys? But anyway, that's what we're looking at. I mean, even when you're outside in, don't forget there's a high probability in things, especially on shares. They can move fast, and you don't know whether this is going to fall or where it's going to go to. You don't know what's causing it to drive off, or that's just you're trying to get when it's extended into a trend, it's extended quite high, and you're looking to short. Is that short turn into a massive short, or is that just a quick nab? So you can do these sorts of things, take a quick gain out of it, but you don't know if it's going to turn into. So if we've had a massive trend on the weekly, you've had this big move higher, and on the daily, you're looking to enter. So I'm just trying to draw it properly. Let's just take a step back. So this is your weekly trend. You've driven higher. So really, once you've got a weekly trend that's really up here, it could be right up into a resistance zone, or it's into clear skies, but it's well established and everyone knows what's going on. Now, if there's a change of tune where fundamentals, I'm just talking purely on stocks, by the way, the fundamentals come out, then you could easily get sort of, you're looking for a trade to potentially be like that can actually start to get some legs on it and really drive lower, and you're on the right side of it. So they can turn into, even though it's a sort of a high probability or high strike rate, your hit rate on the positive side is higher. You can get some good ones. You can get some really good returns, and they come, especially on the short side. If anyone's traded shorts, whether they've just traded I know probably Helen's done a bit of intraday on the SPY and stuff like that. On the short side, you tend to get them, they can come hard and fast. And you don't have to second guess whether you're right or wrong. You're going to be told pretty quick. You're going to find out pretty quick. So that's what we're trying to say. We're going from generally from expansion, from contraction into expansion when you're going from inside out. And there is potential where you can take it on the short side, especially shorter term on your stocks and bits and pieces. But what we'll do, we'll show you some examples of what I've just been marking up over the past probably couple of weeks, and some trades that we've done on a similar style. And basically, I'll break it down on the setups because it's interesting. You can't just go willy nilly. Sell when you think it's extended, buy when it's on the MAs and things like that. I'll show you what setups we got, which is the basics of it. But there's also a bit of planning and things to look at to nut out, or when you should go long, when you should go short. With regards to momentum, what is momentum coming down? Is momentum, if it's up here, is momentum easing here, which you can see stochastics are coming down. It's starting to run out of steam. You got this candle here is a great sort of heads up where, okay, we can be on the short side purely on a break of that, or on a break of this green candle. Once it breaks down there, there's some potential selling coming in. We don't know where it's going to, and as such, you've probably got a week or so where you could have taken some gains off the table looking at your daily chart, or this thing could have just completely fallen over. There's obviously a few things you've got to take into account before you start jumping in, but you've got the basic, I guess, template of what we're looking at. Is it Flight Center? So this to me is more of an inside-out trade as well. So you've got the market contracting in, you're starting to get some high lows holding, and we're looking for that off the MAs higher. If we go to the daily, it's probably a bit clearer. It's more of, we're looking for that pullback, we're looking for that expansion higher. So it's more of inside out, meaning bouncing off the MAs higher. So you've seen that trade many times. Let's just get into the, now what I just had up, where is it, that one? Yeah, so this is, Bobby, this is just what we're looking at now. So the indicators we're liking to use is, say, you can put a 20 EMA, and that's your sort of your key for whether it's going to be inside out, outside in, and so on. Then we have that 20 offset, okay, by a certain percentage, and that certain percentage will depending on what market you're looking at. So what you're really trying to do is, this is a 30-minute chart of the SPY. All right, so that setting on the 30-minute chart of what your offset, the top MA and the bottom, is different to the 5-minute, for example. So what you're trying to just get is when it's swinging up and when it starts to fail. You're trying to get the top MA to sort of, how do you say, encapsulate that? Like we are here. We could have, if we made that narrow, most of the action is going to be above that MA. But what we want to try and do is get it into a band where most of the action's within the bottom and the top, and they're just offset by the same amount. So you might offset by, I think it's just under 1% here on the 30-minute on both sides of that 20-minute MA. So it's the same EMA, 20 EMA, just offset on the upside, plus say 0.6% and minus 0.6%. On the 5-minute, we're set it at 0.3 and 0.3 above and below, and it seems to encapsulate most of the action as well. And then we're trying to, so what it is really a guide of what the most recent action is. You can see most recent action is up here, then it's contracting, then it's expanding. So we're sort of getting to that point where we're expanding, and probably just the last, well, today and action from Friday, we seem to be going sideways, and you can see that by the MA at the top on the 30 is pretty much sideways, just starting to lift with this price action today when we opened, and it's sideways. So we're looking potentially for something to bounce off the MAs, maybe on the 30, or you could look on your 5. We're looking for an inside out potentially, but it all comes down to sort of what your momentum's doing. You can see we've also got a momentum indicator, and I'm probably fiddling around the MACD because I think on different packages you get different indicators as well, which give you a better idea where it's swinging. So if we're looking at just, oh, it didn't quite work, did it? No. Anyway, so I'm playing around with the MACD at the moment, and you can see that when it's above, you've got positive momentum, buying momentum, but it's not too, it seemed to run out of steam. It got up here, it ran out of steam, and that's actually coincided with the resistance zone. And what we're looking for is a swing in momentum, swinging up, and we're looking for that inside out. And when it gets to an extreme point, we're looking for an outside in type of trade. Does that make sense? So I'll draw up. I've got this here, which I've shown 3 times already, and what we're sort of looking for. All right, so here, this is the open, and I think I've got, if I just get the 19th, I'll get that, I think I've got the 30-minute chart here. So this is a 30-minute chart, and you can see what we've marked up. So your prep prior would be trying to mark up where sort of liquidity zone might be, where you might find some selling reaction to push the market lower, or buyers just try to defend the market. And at that stage, you might have had a resistance zone sort of this high, potentially up at this high. So in between there, we could have some liquidity in there. And don't forget, we're looking at 2 moves. So that's 1 move down, 1, 2 moves up. So to me, what I'm looking for, that's your move down. Or, if it's reversed, if you're looking for an up move, you're sort of looking 2 moves back, just to clean out a few of those buyers or sellers. So this strong move down is followed by sort of that 2 moves up. So in essence, what we'd be looking for is some sort of selling liquidity, because we've already done that 2 pops, if this is making sense. So a basic premise, I'll take one step back. A basic premise is if you've got a strong move up, we're looking to, and it's the higher it goes, the more likelihood we're going to see 2 moves down, just to clean out some traders, some buyers, put them back on the sidelines. And the same on the flip side, like this, we've got a strong move down, and we're looking sort of at two moves or 2 waves up, or 2 waves up is probably a good idea, but being within the low, the high. And so that's probably only somewhere around 50% retracement, give or take, maybe 60% retracement of that move down. But those 2 moves, what it does is catch, you got initial buying, pull back, they're feeling confident, you get some more buying coming in, and it just turns around and squeezes out some more sellers of this move out without really, kicking on too strong and having a really strong move up. So if you just bounced straight back up to the highs, you probably negate any shorts, because that's a strong move down, but it's been counteracted with a really strong move straight back up again. So we like to see those 2 moves, and you've got that. So prior to the open, which is this green candle here, we've got a liquidity zone. All right, so we've got it somewhere around the high and the secondary high of those 2 legs up. But what we've also got, which I didn't draw in because I was probably late to come in marking this up, was a lower liquidity zone. So we've closed, if you can see, this green candles are closed. So we've got a sort of buy liquidity zone, which potentially is down here, because we could be completely wrong. It might not be 2 moves, and might just start to jam straight back up to those highs. So we've got a liquidity zone down here as well. Problem is, it's gap down on the open, straight down to this low, and that sort of negates any of that buy liquidity zone. That's why I'm guessing I just didn't draw it up at all on the 30-minute chart, because it was after the fact. But what we can see here is gap down, and normally, I don't know if anyone knows the old term gap and trap. It can gap down, trap some traders on the short side. Anyone that's been stopped in here on the shorts right down in a prior low, and then trap them for a move straight back up again and clean them back out, which is what it did. So we'll go back. That's probably the most interesting. And then we move straight back up into that liquidity zone. So on the bigger time frame, this, as soon as you get down here, this high is confirmed, or this liquidity zone is confirmed, because what we're looking for is potentially a major 2-legged move down. All right, so that's the premise of what we're looking at. Go back to this is a 5-minute chart. So there was an entry off here. It was probably a bit tougher. So my entry setup, look, I didn't really get into that. I think I was watching it. I'm not sure whether I was watching that or I saw it a bit later on. I might have been talking in the morning report. That was at 9:50 when it opened up. I might have been talking, just sort of watching that. So good gap down. Was looking for the lower high, but instead it come all the way back up. So it's quite a good little rally. Okay. What I did do, excuse me, was short in here. And that's more of your inside out. So the market's going sideways. So we had the potential that this is going to turn around. Anyone's at long off that low is sooner or later they've, that gap and trap move here. It's gapped down, trapped some shorts, squeezed them back out, probably gone a bit overboard. You've come straight back to where it closed the overnight session, a little bit above. There's potential where these longs that are built up here are sooner or later going to have to get squeezed out of the market and get stopped out or close. And that's what we're looking for. So it was basically an entry below that red candle, like I think we've spoken about a few times. Entry there, looking for a move potentially from inside out, which you can see that a couple of about 10 minutes later didn't work out. Yeah, no, they don't, Helen. I think it's a lot of it is an intraday thing. I think that's my theory anyway. I don't think share traders as such. If you're pure share trader, you probably haven't heard of it too much, or they seem to ride through them. You know, if they're long gaps down, they don't bother with it. They just think sooner or later it's going to come back. Or who knows? But I think intraday you really got to look at things like that because there's opportunity and you don't want to get caught up in a gap because a lot of the times intraday they'll go back and fill the gap. So that there, is really a high probability set up on the buy side. You've got momentum's not super strong. It's gap down. It's gap down. Don't forget from our 30-minute chart, it's gap down to a support zone, a potential support zone, and it started to find some buyers. So it's a prime example of, it's gap down. There's opportunity. There's opportunity on the buy side. Whether you took it, probably for me, I would like to have seen that first green candle. Yeah, okay, it's spiked down. It's finished on the upside. Potentially on the close of that secondary green candle, and you could have had, I guess, 10 points or so. Yeah, about 10 points, at least that reversion to the mean style, closing the gap. You've got 10 points, but if you held it, you've probably got a bit more than that, maybe 15 points on the upside, just on that one trade. Now, if you're trading one SPY contract, what's that? 250, 375, just for one contract, $375 for that trade, and probably took no more than about half an hour. So that was quite clean. Now, like I said, I shorted this, looking for that inside out style of trade, probably a little bit, on the other side. But the thing is, the overall trend is sideways at the moment. We haven't got any clear direction, so it's quite, it's worthwhile taking a punt on that. I shorted it, made a few points, and then realized that it wasn't going anywhere. And this actually turned out to be, you could have taken a long on the break of this green candle, all right, for an inside out, but just a reverse. So what you'll be looking for, it's come back in, it's found some support straight on that 20 MA. So what we'd be looking for here is a move up to the top side, or at least a good strong rally. Now, what played out and what you've got to take note of, there's a few little points. It did play out, so you could have made a few points on that, no problem at all. And what I'm tending to do, I like my stops on this 5 minute. I like to get stopped in when it breaks. Say this, I keep hitting my mouse. If you can see what I'm talking about, the first red candle, it breaks the low. I've got my stop above. It's 5 or 6 points thereabouts, and then I'm trying to follow it down. My stops tend to go above the high of the last 5 minute candle, which would have been stopped out somewhere on this. I would have got flushed out on this red candle here. Then it's turned out all right. So that, again, if you just flipped it around, you look for your entry on the break, which is this green expansion candle. Buy on the break there, my stop below. Again, it's only a 5-point risk, and I'm looking for it at least to take out that high, or trading up to that high. I could have been 5 to 10 points up, and then stop that again. So again, it's just a small. So it's not Bollinger at all. It's just a two EMA. So they're all EMAs, a 20 EMA, and they've just moved up a certain percentage and down a certain percentage, or offset is what you can say. It's not Bollinger Bands, so it's more just your EMA. So you can do your SMA, and you can offset the SMA by, I don't know, 0.3%. We've got this one set out. So it's just exactly the same. So that's why they don't look like they're coming in or going apart. And that's what we found by offsetting them, say 0.3%. It's encapsulating most of the swing levels. And that's the idea. You're trying to encapsulate where there's a high likelihood it's going to swing, or somewhere around the bottom, like this one here swung around the bottom. It kept driving low, but it didn't quite really spike through. And the same on the upside. I should probably show you some examples later. But that's all we're looking for. Now, one key point, and why this turned out to be a really, really good short. Now, I don't think I took this short. It was around midday. But what I was looking at, you can see it got through that high, but there's no real strength. And the momentum's positive. There's some buying momentum pushing it up. And a lot of the times, if it's going to set up one side or the other, they want to clean out. And that's all this is a major M pattern. I know Helen knows about it. We'll talk about this sort of in our education and what we're looking at. But N patterns and W patterns, when the market powers up, so when it pulls back here, if you're buying in here, you expect a similar type of strong move up. When that fails and the momentum really starts to fail once it gets through that high, which you can see are basically a green candle, we know that people are going to buy on stop up here. on a breakthrough there, and they're probably going to have their stop below. And again, this was a gap and trap. It's not a gap, but it's still a trap. So that makes sense. So it's going to trap some traders in that have gone long up here. They're going to have to turn around and bail and sell. And it's, again, we're looking for that swing again lower. But the reason why I would have got into this one on the short side was not so much on that that first red candle on the short, because it could easily just turn, had a minor pullback and go straight to the outside again, like we were just discussing an inside-out style of trade. And because of this original powerful leg up, you probably want a little bit more confirmation, which played out perfectly. A couple of red candles, a minor, we call it an RTF, retest fail. So it's retested this previous high, only on a minor level, but retest fails when it pops up. Yeah, sorry, John, I just saw your comment then. If your best thing, jump onto the demo for Trade Direct and play around with it. And it's just, there's a setting there, there's a certain, let me just find it. It's called momentum envelope. Okay, MA envelope. So you can set up whether you want to stick SMA, EMA, or whatever, and what you want to. Well, let's just show you. We've got a 20 period on the close. We've done this by 0.6. This is a half an hour chart. Exponential moving average, and away you go. Just press done. So you can offset it easily, and then you can play around with the settings, and you can just see how different markets react, and whether you're going to look for something that's setting up on the inside out, which we've talked quite a bit about, or outside in. All right, so just play around that. If you've got any questions, John, just shoot us an email and I'll get back to you. Yeah, it's probably, you may find, I think generally they might call it different packages, call it different things. We've got it as an MA envelope on Trade Direct. I think, not sure, I've looked at IG. I'm not sure what IG have got it as. They might have something, called it something different, but it's pretty much the same thing. But you just want to be able to offset your moving averages. So that's, yeah, so if anyone can see, this is a major M pattern, okay? So the heads up was, we've got through the high. It's not showing us as much strength as what we would have expected. We've got a couple of red candles, so that's a heads up where, oh, hang on a sec, if this turns into M pattern, it's another, essentially an inside out style of trade. And first target would be just to test that low, which, okay, if you get that, you've probably got 5-10 points up your sleeve. But if it goes through that low and starts to clean out a lot of these buyers that are built up in all this move up, we could go further. And that was the premise. And if you can see, what I want to do is overlay this. I just want to draw. There's also, and this is getting, it's not complicated. It kind of is. But we talk about M patterns, and no, that's not what I wanted. So delete that. I wanted this. But it's a same sort of thing, just on a smaller time frame. So what you've got here is a big M pattern. All right, that played out. But if you're looking at this as potentially being the other side of the M, and we're looking for that M pattern, we've actually got a minor M pattern playing out here. Okay, so that's an M within an M, if that makes sense. So it's the same. We're just looking for the same side of the thing. We've got our what we're looking for. We're not looking for anything complicated. We're not looking for a ton of different things. We're looking for the same small things, but they can just appear. I think what people don't put much emphasis on is different time frames. They might stick to the same time frame and try to overcomplicate it with different settings and different this. So when you're trying to set up your strategy or your trading plan, you've got too many inputs to worry about. Whereas I would prefer to have different time frames and a few different inputs, but I'll just use them on different time frames, and you're getting the same. Once you've done your back testing and everything, they play out quite nicely, and they play out often. They play out well, and the probabilities on your side. So this might be what I've found in the past for my intraday trading. I'm sitting around the 65% mark strike rate. Obviously, my biggest problem was holding, and holding was the key for me. When I started holding them and doing that same style over and over again, rinse and repeat, I held them longer, bang, all of a sudden you become more profitable. And that's all the key was for me. Once I started taking my stats, looking at them, marking up the charts exactly like I've done here, putting my notes on and going, okay, where did I get out? Oh, I might have got out here, and I might have had a long, a few points here. I got out well here. Okay, so I did get out. I think I made a few points here. I didn't take this long. maybe I've taken this short. Or for instance, like today, I'll show you in a minute, I did have a long on, stopped out, 6 points, and then made it back on the short. But if that sort of happens and I don't let it run, which would happen to me more often than not, it's these ones that I'm missing out on. And this could have been, I don't know, 30 pointer on the downside before you potentially got stopped out somewhere down here. And the entry was essentially a break of that, M pattern. You're trying to break the low, you enter, you got your stop above, or you might have it on one of these 5-minute candles, knowing that M pattern normally leads to lower prices. And then couple that with a bigger M pattern, which is going to lend to lower prices. That's why you've got this really big move down. Does that make sense to you guys? Is it sort of coming together? I can easily send you this chart if you like, just to keep an eye on. I've got a few others I can shoot you across. Just email me and I'll send those across. If that makes sense, we've got the inside out here. This trade, if you start marking that up as an outside in, I don't think it's not a massive probability, because what you want is more something like this. It spikes into a level and then you got that reaction back, that reversion to the mean. Whereas something like this, it's got this massive M pattern. It's come all the way back down on a solid move that really, you've got probably 10, 15 red candles there. You expect more of a grind. You don't expect it to come strong move down and just bounce straight back. You expect more, something like this, which I would rather be out of. I think that could be a waste of time, because it could easily turn into something, you have a break-even trade, a small gain, or you get stopped out for a small loss. I don't want to get caught up in that sort of rubbish. I'd rather something like this, this is essentially a move down and it's reacted straight back up. And you want to get into that. It pops back up, that reversion to the mean. Whereas this one, it's more the MAs catching up with you because you've had quite a strong move down. I hope that makes sense anyway. So that was those ones there. I've got one other. Close that down. I've got something else which has got some good, we've marked up some good, I'll close that. No, I'll just close there. Here's one which I can't remember where I traded this one. I think I might have traded it long. I think I did. I traded it long here and got a bit of a run up and got stopped out somewhere up here. So again, what we've marked up our 30-minute chart. If I can get that. It's the fourth. Yeah, didn't mark up. No, that's not the one. It's the same chart. Okay. So the premise coming into the session was that, okay, we've got a potential for a resistance zone, an RTF, we call it, retest fail. So if the market can power into that level, there's a good chance it's going to react up off that level. And that was the idea. And as you can see, once you mark up this after the fact, you can see that the market's come down. It's react off this zone at 64.84, 85, pop back up, and I think this was the close. Yeah, around 25. I think it was the close of the night session. And this open here was just from the start of the day. The first 10 minutes, say, and it drove down into that support. And you can see it did react back off because the market was getting stretched. So it's all the similar indicators we look at when we're talking shares. If a market presses into a zone and it's extended, there is a higher probability that it's going to bounce or it's going to react up off that zone, or the reverse. For a lot of the times when you're seeing when we do the shares, we do the inside out. So if it's coming into a resistance zone, say here, for example, if extending into resistance zone, we've got pretty much like this. You've got the stochastics of where the pressure of buying is running at. There's not much left in that buy move to continue on up. It may need to reset, and if it resets, we don't know where it's going to. So that's why we tend to like to take partial exits into a key high. If it's clear skies, you can tend to let it go a bit more. They tend to go a bit harder because there's no sort of clear resistance zone where it could react off. And that's what we got here. The market's propped up. This is a marked up level, a prior high. We are extended on whatever this is, a 30-minute time frame. So here you can see it's getting wicky. When things get wicky, as in it gets rejected, you know that there's some selling going on, more selling than prior. Does that make sense? So here you probably either want to take some off if you're long, for instance, or you could be looking for a short at that stage. But that's the reverse of what we saw here. It's powered into a zone. We're getting sort of overextended on the downside. We want to see if there is a reaction, because if there's a reaction, if it just continues going, we'd probably miss the trade altogether. So what we'd be looking for is something off that zone, which it didn't really play out on the long side. And what I tend to do is look for, this is what we talk about, the two legs, 1, 2. So you can see I've marked up that. So that's your two legs down. It did react off there. And what it's more often than not is going to do is going to have your secondary leg just to, for lack of a better word, screw those people that bought the market a bit too early and then not watching the action. So that's sort of, if you trade intraday, is key. We always talk about two legs. It's sort of key. If you can keep an eye on that, especially when the market's got a bit excited on the downside, like this is really expanded down, we come straight back down to the lower MA. We're into that resistance zone. It didn't break it. If this was going to bounce, you would have gone straight through that first red candle. If you can see this on this one, straight back up to the middle, back to reversion to the mean. Then instead, it's stalled. Next candle was down. Next candle's up. That, to me, you don't really want to go long just there. You'd be looking for that secondary move down just to clean out these buyers that have been trying to buy it off that off the support. And then what it's also done is clean out some stops that are probably longer term stops below that level, and it's triggered them. And then it stalls. And then as soon as it stalls, and the momentum's starting to, you can see it's starting to curve back up. The momentum's probably overextended. It hasn't really got excited to the upside just yet, but we've got that change in momentum. So you could have potentially taken along. I wouldn't have taken one anywhere there because I just don't think that's a clean setup for me. I'd rather see some sort of contraction, a really narrow body candle, which I can buy and I could really minimize my risk. So if we talk about this now, what we've seen is essentially that reverse. We just talked about an M pattern. We've got a W pattern here. If you can see, so that's one move down. Just remember that is one move down. We've sort of come back up. We've come back down, and so we've got that W starting to play out. Or you can call it a higher low, which we talk about. So you can see the action was getting a bit grindy. It's getting a bit toppy up here. There's probably still some selling to come in, but what happened? The buy momentum wasn't very strong, and it ran out of steam, and you got divergence. So all these sorts of things we're marking out. We're trying to get an idea of what the momentum's doing, which way we can go short, we can go long. We could have gone short through here with a stop above. To me, that's a bit too much risk for what I like. So essentially what I was looking for is this. I want to see some sort of higher low because this is a key level, a major level. What we've done, we've pressured down and we started to stall. You can see the momentum still on the buy side, only ever so slightly. We've got the candles, narrow range candle, and we're looking for contraction to expansion. So this is the potential zone where we could be looking for a higher low to play out, which it did. I think I took it long just on that break, and I'm looking for that inside out style of trade again. And it pop up, would have got stopped. I think I stopped out. I can't remember where it stopped out, but somewhere up here. Might not have been perfect, but I think I might have just taken off. But anyway, you can see what we're talking about. Is this? We've only touched on a few things, but this is what we're going to be basing what we're looking at. And there's obviously different setups. You still go through the process of trying to set up your zone. So there's one, your first step is coming into a trading session, especially if you're intraday trading, or if you're more of a position trader, you might be sticking more to your inside out style of trading. If you're longer term, but you're still looking at what your weekly charts are doing, you're still looking at what your daily charts are doing, and you're prepping what you want to see. And if it starts to play out, then you're obliged to buy. It's the same when you're doing your intraday. We know what we want to see. We know where our zones are, and there's a few key sort of points we're looking for before you start putting risk into the market. So this one, like we said, did play out okay, but it really didn't do too much. But again, it's off a similar type of W pattern. And by W, we've got patterns where M, we're looking for either lower highs, can play out like that, can play out like that. And W is just reversion. You've got divergence there, depending on what your momentum's doing. But it's all a very similar type of process, I guess. And we're looking for some opportunity where it's contracting in, around the 20 EMA, we're looking for expansion to the upside. When it gets extended, like it did here, we're looking for some sort of buy opportunity. You wouldn't want to sell in here because you are getting a bit extended here, and you probably expect generally with indices, foreign exchange, that sort of thing, you do expect reversion to mean a lot more often. When you're share trading and you've taken a long position, obviously, when it's in the clear skies, because stocks are pretty much geared up to go up, people don't really sell them short as much as they do, your currencies, your indices, and things like that. You can probably hold them a bit longer and trade your inside out style. But there is opportunity for short-term trading using CFDs to short into. Anyway, guys, that's probably yeah. One just needs the courage to act accordingly, and that's what it is. I think I know I talk about this a lot, so is marking up some trades, and what I've only just started marking up again using the MAs, but it's a similar style I've used many times, and Davin he's used this over the years too. And this is pretty much his key style of trading, intraday, and it's not just intraday; it's share trading as well. You're doing a similar style. Let's see if we've got something else. Marking up this probably wasn't too much there, but it's an outside in style. Maybe it didn't play out until you've got this red candle played out and you got straight back to the mean. Probably not a lot in that, but just by marking it up, there's opportunities, and you can mark up some opportunities. Sometimes it doesn't have to just go straight to the mean. If you start getting, you could hold this one, for instance. If we shorted it on the break of that green candle because it's struggling to get up, you can see the momentum's come off. We've got divergence, price going sideways, momentum coming off. Okay, we want to potentially look for a short, and you can see that actually. Just quickly draw it. You've got this sort of contraction happening, and then okay, look, there's enough selling up here. The momentum's coming off. Sooner or later, there's the buyers from this, this move up are going to have to take some profits, and we just enter on a short below that green candle because by then it's probably broken. I think it did. By the time you get short there, it's broken the bottom, coming out the bottom end of that candle, stops above, and then you're really just managing your risk. Manage your risk here. Potentially stopped out about here. Not much into it. If you could have held it a bit better, you could have got more out of it. But who's to know that's going to keep pushing down? So you could be gunning from, depending on what you want to do, from one side, reversion to the mean, or see if you can get from side to side, essentially. Okay, it's going to depend on what prep you're doing. It's a lot of the times it's harder when you got this market. You can see it's going higher to sell. You're better off just sticking to a reversion to the mean style, as in from outside in. If the market's heading up, generally heading up, and you've got a deep pullback, you could go hold it longer if it's that type of move, when you're going with the trend. So it's going against the trend on this stage, going with the trend, something here. You've probably got to outside in right at the start of the day. Inside out, sorry. All right, probably call it a day. There you go. No secrets. So what I think, trying to get this style, it sounds sort of complicated, but I think sticking to a few key points, I think you can make a go of it. And I think you can apply this to, your currencies, your indices, your intraday, your longer term. You just have to sort of play around with what you mainly play around with is the MAs, and you're trying to factor in where they're going to turn. You're trying to get the turning points, and like we're saying, this is inside out. You're trying to get, where we're going to follow, where we're going to find a bit of resistance. Do I want to take? Is it worth taking half off with this trade? For instance, we've got a FLT, was it Flight Center? Obviously, we're not taking any off yet because we're still down. But if this gets ahead of steam and we start heading higher, are we coming into a zone where, okay, we might be up 5 or 10%? Should I take some off, or does this look like it's going to keep going? All that sort of thing. It's a good way to analyze what you're doing, your risk, and managing your risk as you're trading. All right, probably call it a day there, guys. Thanks for joining me. If there's any comments you'd like to make or you'd point out, feel free to send through an email to support@tradesetup.com.au. Any more questions, just send us an email. If you want some of those charts, send us the email and I'll shoot it out. Anything at all, just send it through. And don't forget, we will be developing, putting together, well, we are doing it at the moment, putting together an education sort of a package built around this style and what some key points to look for, to train yourself to look for, and then build your trading strategy on top of that. All right, guys, fantastic. Thanks for joining me. We'll speak to you again probably tomorrow morning, more than likely. Have a good day, guys. Bye.